I would say taking an approach of not getting caught up with lifestyle, not getting caught up with instant gratification, but looking to put in investments that build passive income and starting right away. Start thinking like an investor immediately, and you're going to have a much better long-term outcome. Because 20 years in, you'll made all of these commission dollars, and if you've invested a good chunk of them, you're going to have a pretty big passive income coming in each month, and that's your best insurance policy.
Welcome to the Raquel Show. This show is for entrepreneurs who want to play bigger in business and in life. And as many of you know, I love bringing people who love to play bigger on the show. And today I have a very special guest who founded ARC Multifamily Group and is a real estate industry veteran with over 2 decades of investing and operating experience. He has personally managed over 120 million in construction and value add projects. I love talking to people like him because he's got the experience. And I know several of you all listen to the show, want to learn about investing. So I can't wait for you all to hear from him. Welcome to the show, Robert.
Thank you so much, Raquel. Looking forward to it.
Awesome. So we're going to dive right in. And I'm just curious, what really got you interested? You've been doing this for over 2 decades. What
Yeah.
got you interested into the real estate investing side of it versus all the other facets of real estate?
Great questions. I started my career as an engineer. My undergrad was in computer and electrical engineering, and so I grew up in Toronto, Canada, moved out to Orange County, California after undergrad, and started as an engineer. And then I went to business school at UC Irvine, which is a local business school. Graduated in 2008, and I, at the time, wanted to work in real estate, transitioned from engineering into real estate. And I graduated at just about the worst possible time to look for a job in real estate. Instead, what I did was I created a job for myself with a couple of partners. We started flipping homes in areas that had been hit really hard during the great financial crisis. And so in between 2008 2019, I was a home developer, and I built along with a couple of partners, we built 250 homes over that 12-year span. Mostly all in Southern California, between LA, Orange, Riverside, and San Diego counties, and ranging from flips where we would buy for 100,000, put 30,000 into it, and sell it for 175 to 200,000. And along the way, we got into luxury development and built several $1 million homes, where the most recent homes, in fact, that I've been invested in. Now I'm a passive investor with my partners, but we're building homes that are in the $7 to $12 million price range in the luxury space in Southern California. So that was my construction and home building experience. Along the way, and so to your question of why investing, obviously that was my in, because a regular job in real estate didn't present itself in 2008. And then once I got a taste of working for myself and the ability to scale something, it just made more sense for me to be on my own and be the head of something versus working for someone else.
Oh my gosh, what a neat story of all the different facets, from like flipping in the worst times. Like you said, that's probably the biggest crash that I've seen in real estate, and
Yeah.
then to where you're at today. So then what motivated you? You went from like luxury home building to like really start ARC, this multi-family group.
Great question. So I had started working prior to him joining Real, Sharon was a business coach. He'd finished his previous stop at a mini version of Real called Telus Properties, sold that company to Douglas Elliman. And then while he was on sabbatical from the direct real estate brokerage ownership, he was consultant to entrepreneurs. And so I'd started working with Sharon about 6 or 7 years ago, and we looked at my home building business, and I had 2 requirements that I wanted to do. I wanted to have something that could scale, because I knew at any given time we had about a dozen projects on the go, about 20 million of investor capital, including my own money in those projects. And while that was exciting, I wanted something that could be bigger. I also was looking for something that would be more in part and parcel with being scalable, I wanted something that would have consistent cash flows, because this was more of a business where you own a bunch of assets, you're building, there's no cash flow along the way. When you sell them, if you sell them profitably, you get paid, pay the investors back first, and then you get paid, and then you recycle and get new assets. So it was a lot of chunk money, but not consistent cash flow. In looking at different facets, we decided that residential was something where I had a very strong background. Multifamily was the closest thing to residential real estate, so we decided to start ARC in 2019 in the value add multifamily space. And what the value add multifamily space is, looking for properties that have below market rents. So you go in, you buy the asset, you improve the management. You might do a lot of physical improvements to units and common amenities. We typically buy assets that are 100 to 500 in units in size. We don't buy anything less than 100 units. Price range could be anywhere from our most affordable purchase price was 10 million, and our most expensive acquisition was 89 million. So we run the gamut quite a bit. It's all based on, but it fundamentally is based on, can we grow the rents enough to create enough value in the asset from what we paid for it versus what we're looking to sell it for. Not only can we pay investors cash flow along the way, but also grow their equity, with our goal being to, between cash flow and equity growth, if an investor puts $100,000 with ARC, our goal is to double that money in 5 years, give them their 100 grand back plus cash flow quarterly. And then if you add the equity growth on top of that, when we go to sell, in sometime between year 3 and 5 is when we're going to sell. Based on how we've grown the income, we expect the asset to have gone up quite a bit in value. When we sell the asset and pay back the investors, we hope for a 2x return.
Wow. Now, do you guys invest all over North America? Where's
Great.
your
Yeah,
areas of concentration?
we are right now hyper focused on the Southeast. So we have our headquarters is in Atlanta, Georgia. We've got 1,400 units in Georgia, 300 units in Alabama. We've got another 334 units that we actually have under contract right now. We're going to close on at the end of March, which is a beautiful asset. It's called the Preston. It was a $53 million purchase price. But to give you a breakdown, because this will be great for your real estate audience, we're buying the Preston for $158,000 a unit. We're going to put about $15,000 per unit into it, including common amenities, clubhouse, pool, that kind of stuff that we're enhancing, and then improvements inside the units themselves. Our goal is, so if you take the 158 plus the 15, we're all in at about 173,000 per unit. Our pro forma rents that we expect to achieve on average are $1,700 a month. So like that ratio is just excellent, right? If you think about it, it's almost like you're buying a single family home for 173,000 that's got rents of 1,700.
Mm-hmm.
And those are the kind of ratios that we seek, because if we can accomplish those, we know that those are above average returns that we're hitting when in the time we own the asset. So when we go to sell, knowing that the market is actually going to bear lower returns than what we've achieved, that's how we eke out the profits that then get shared between the investors and ARC.
Okay, so what factors should real estate investors who are considering doing this, if they're going to get started, what should they consider?
I would look at it two fronts. If they're doing stuff that's smaller, single family, do fourplex development, or rather value add development, then part of it is having the capital, finding good deals that are below market, and making sure you can actually add value to the asset, because that's the best way to take something and make it more valuable while you own it. That's one way to do it. The way we have over 200 investors now at ARC. Many of them are realtors. Many of them are realtors at Real, where I know you are currently. And a lot of them, they invest with us because they're getting solid returns. It works out to about 20% annualized. So love what they see in what we do, because this is all that we do. This is our focus at ARC. It allows them to do what they do best as well, right? So it's like being an investor in a passive capacity while getting really solid returns with a proven operator is just a good symbiotic fit, because it allows you to just do exactly what you do in the real estate space, in sales, marketing, whatever that happens to be. So that's another way to go about it. So I think there's, and a lot of people do a hybrid of the two, where they might have some of their own investments, and then they also want to play in a bigger space. What I don't advise is someone who's looking to buy a 100-unit apartment complex where they're going to look to do it part-time. That's really tough. And what will happen is, if you're doing it part-time, the brokers, and I know there's a lot of realtors on this show, so I don't mean it in a derogatory sense, but brokers are going to sell if someone looks to be sold, a broker's going to sell them. More than likely, the beat up property that's a dog is going to be sold to a newbie who's going to make a really big mistake. I would say if you're playing in a bigger pond, you're much better off going with a proven operator like ARC, and instead of trying to navigate something like that on your own, or crowdfunding with a bunch of friends, and then nobody really knows what they're doing, but they've raised the money. So they, again, you go back to the broker, they're like, great, somebody new with a pot of money, let's sell them something that may or may not work out, but who cares? With us, the brokers now know we've got 2,000 units and growing in a good way. It's okay. They're a great company to work with, but they also have a good memory. So if we sell them something that doesn't work out well, that's not going to reflect well on the broker. So they're being very careful with how they market stuff to us. So we're getting good deals day one.
That's so interesting and that's so good because there's a lot of people that listen to the show that are realtors. Is what would they need? Because you said you guys work with a lot of realtors today, many at our company. Is what would they need to get started with you guys?
To get
Would they need a
started,
certain amount of capital? Do they need
yeah,
a heartbeat? Is it state
that's
out?
a great question. We typically only right now are working with accredited investors, and accredited investors have one of two designations. If it's income based, if they're single, their last 2 years of income, adjusted gross income would have to be over 200,000 and above. If they're married, it would have to be 300,000 and above. If they don't meet the income requirement, then the other way to qualify is to have a net worth requirement, which is $1 million of net worth, not including the equity in your primary residence. So that can include retirement funds. It can include other investments that you have, investment properties and whatnot. It just can't include your primary residence equity. Those are the two ways to become accredited, and then you can invest with us. Our minimum is $100,000. And so that's really the only criteria. And then we typically will have a conversation with the investor, make sure that we're a fit for them and that they're a fit for us. And then as we have our next offering, which we typically will have one offering a quarter, then they're welcome to come in after they've fully vetted our business plan, have had a chance to really look at things, ask us questions. I don't want an investor to be sold by us. I want them to want to work with us. I trust in all. I've been doing this for 2 decades. I've never had a disappointed investor, knock on wood. So we're careful. I'm not a genius. We're just careful in what we buy. So therefore things work out. But at the same time, you want people to know what they're getting into. So that way they have a really happy experience.
How long do they have to have their capital with you guys?
Once it's with us, in a deal, it's there until we sell the deal or refinance and then cash them out. We strive for a 3 to 5 year hold period. Our intention is to try and sell in as soon as 3 years. But we give ourselves up to 5 years typically to make sure that the way our business model works is we do most of the value add in the first 18 to 24 months. So we bring the income, and the income is sitting at 80% of where it should be. We're going to push that to 100% in the first 2 years. After that, we're just between year 3 and 5, we're just timing when to sell. We're riding along with inflation, and we wait for a dip in treasuries, we know that the real estate market is starting to heat up again, then it's a prime opportunity for us to look to sell for a good return.
I love it. What strategies would you recommend for financing real estate investments with those that don't have 100,000 today? Where can they get started?
So if they don't have $100,000 today, then my thing is to save up and then come work with us when they do. If they're looking to do stuff on their own, what's great is I would say the deal chases the money chases the deal, not the other way around.
Yeah.
If you have a really good deal, you will find partners that want to buy it. Right? I've been on the phone with people. Obviously I run ARC and that's my job, and where I place all my attention. But I make investments in other things where it makes sense to do. So I've been on calls with investors where they've told me, hey, I've got this deal and I just don't have the money. And I've funded deals with them because of the fact that it was a good deal. I think the key is like, where do you add value? People can add value by being able to stroke a check and invest in something. They can also add value in being able to find a deal that others want to invest in. They can help on the buy-sell side as you're building up your regular real estate business, looking for how you can absolutely maximize value to your audience. And I think that's the best way to grow the money pile so that you can make these kind of alternate investments as a passive investor.
I love that. What do you think are some of the most common mistakes beginner real estate investors make or should avoid?
I think the two main mistakes is if someone's a passive investor, whether it be in a small project or a large project, don't invest with someone who hasn't done it for a long time, because look at their track record. There's obviously, and I'll get told, how does a new person get started if they don't have a track record? And I say that new person should get money from very close friends and family, because if they do something wrong with it, they're going to hear about it for a long time. But I wouldn't just invest with someone I don't know very well, or just casually, who doesn't have a proven track record in whatever they're doing. So that would be the one thing, or the main thing to avoid making a mistake as a passive investor. As an active investor, mistakes to avoid really is triple check your numbers. Make sure that you're buying something to renovate and then sell, or renovate and then hold. Make sure your rent comps, make sure your sale comps. And then when you're doing things like construction, always assume it's going to take longer and it's going to cost more. So if you factor in contingency, then you're less likely to have a mistake made. And I think sometimes people are so hungry to make a deal work. I've been there myself over the years, where you compromise your numbers. You're like, oh, maybe if I say it's going to cost a little bit less, then and you kid yourself. I've not done that for several years, but early on, it can be tough to wait for that right deal. But it's so much better to have your money sitting in the bank than cleaning up a mess because you overpaid for something.
Yeah, I always tell people the shows that you watch on TV, they always go perfect, but
Totally.
always have some buffer, because that's not what really happens when you're
Not
flipping
at
a
all.
house
Not at
or
all.
you're buying investments.
No, in fact, I have a couple of friends who do this for a living on TV. One prominent couple based in Orange County, they're good friends of ours, and the reality is it's for TV, right? The actual process, real estate development in general, by and large, is a pretty boring. The more boring it is, and the more programmatic it is, the better, or the more likelihood you're going to have a good outcome. If there's too much drama infused in it, or if it's just a train wreck, how do you expect to make money at the end? It's not supposed to, right? It's supposed to be a painful lesson, and if you can avoid the painful lessons, then you're gonna do that much better.
Yeah, so true. They say some people take a lot of time planning out their vacation, and very few take the time to plan out their wealth. Why do
So
you think it takes, especially even with realtors that have the knowledge when it comes to retail residential, of them helping people buy homes? Why do you think it takes them a while, just in general, of them actually investing or building out that real estate portfolio or that wealth plan?
I think it's delayed gratification, right? So it's okay, I have this money in front of me. I've worked hard, I've made commissions. Why shouldn't I spend it? And I think it's a prominent thing. I also think that there's a certain amount of fronting that has to go on in residential real estate. Hey, what car do you drive? And what clothes do you wear? That kind of stuff. I've never been a realtor, so I haven't had to face that, but I've seen a lot of it. I've worked with hundreds of realtors, and realtors and brokers now in the commercial world are my bloodline. Very close. I value the profession extremely. I would say taking an approach of not getting caught up with lifestyle, not getting caught up with instant gratification, but looking to put in investments that build passive income is, yeah, and starting right away rather than, hey, I'm going to do this when. It's no, start thinking like an investor immediately, and you're going to have a much better long-term outcome. Because 20 years in, you'll made all of these commission dollars, and if you've invested a good chunk of them, you're going to have a pretty big passive income coming in each month, and that's your best insurance policy against things like being able to work or slow markets. When you're in a position where you don't have to work, and I've been there for some time now, you make better decisions because you're not forced
Emotional.
into things. It's not emotional. It's really, hey, what do I want to accomplish? Why do I want to accomplish it? Then you just go do it. I think having that mindset is important, right?
Yeah.
It's just,
You've been at this for over 2 decades. What advice would you give your younger self today?
I would have given if I was going back 20 years, I would have told my younger self to do more investment properties instead of flips. And because the investments, we had a bunch of houses that we sold in 2009 where we bought them, let's just say on average, bought them for 100 grand, put 30,000 into them, and sold them for 180. Maybe made 35,000, 40,000 in profit on, let's call it 20 homes.
Mhm.
So that would have been 700,000 to 800,000 in profit. Those homes that we sold for 175 are all worth 450
I was
plus.
gonna say 500,000
Yeah.
probably
And they would have
today. Yeah.
cash flowed the entire time. And so instead of making 800 grand, we'd have made several million there. And we might have sold some and kept others. We didn't keep any of them. So what happens is when real estate it corrects, that's the best time to buy and hold. But
Mhm.
everyone's so afraid, they think it's like a hot potato at that point. When it's at its peak is when you should be selling. And we're in a lot of markets, we're still at peak pricing or not far from peak pricing. So investing is a little bit more difficult right now, long term. But when it does correct, or when you see a good entry point, I would say I would tell my younger self to hold on to more stuff. And then the other thing that I would say is when you're looking at a business model, do even more research than you think you need to do. Work with mentors and coaches out of the gate. I look at a company like Real. I know Sharon's been at Real for a year, and he's a guru in this space. A lot of people have a lot of respect for Sharon because they see the presence that he has in social media and everything else. I've seen it firsthand for years, and so I know that there's amazing credibility, but also tutelage that can be gained from his mentorship. And he's one of many at a company like Real. I would say find the best mentors, soak up what they have to offer. And even in the investing side, get good people to mentor you. They'll spend enough time with you to help you avoid pitfalls. And if you avoid those pitfalls, you're going to be that much further ahead of the game than having to make the mistakes on your own.
I couldn't agree with you anymore. And I love how you actually talked about looking at the different markets at peak and when to buy, when to hold. What are some of the factors? I'm just curious. What are some of the factors? Because how do you time the market? We all wish, like when
Great
we had
question.
lots of properties, we should have sold them in 05 and not 09.
Yeah,
What
so
are some of the things that you guys look at today?
I think part of it is like knowing when you buy a property,
Yep.
buy on good solid fundamentals,
Mhm.
have it cash flow, have your rents continue to rise, treat the property well, make sure it's maintained. But also look and see when things are out of whack. If you have a property that's getting, for instance, the one I'm buying right now, right? If we're buying it where our all-in cost is 173,000 a unit, and we're going to get, we hope, $1,700 a month in rent. Then that's a good ratio. If that same property had buyers looking at it at 300,000 a unit and the rent was 1,800, that ratio is not so good. If someone wants to buy it, they're welcome to buy it from me at that point because I'm going to realize a whopping profit, and then I can wait for that property or another property like it to come down in price. I think having a good pulse where value should closely track rents. If they get too far out of whack, then there's an opportunity to sell, take money off the table, and wait it out. Oftentimes, people will not sell because they don't know what else to do with the money. But then, when in a downtime, then they regret not having sold, right? So
Right.
there's always having a pulse on the market and making sure that things are not out of whack will serve people well.
Yeah. Any books, podcasts, or things that you would recommend to our listeners today when it comes to learning more about real estate investing?
Yeah, I always recommend Sharon's content. It's really good. You can check it out from sharon.com. Bigger Pockets is really good. They are, great in the investing space in general. They have a strong presence with things like multifamily, which is what I do at ARC. And as far as books are concerned, I still think the Rich Dad Poor Dad books are a great way to get an idea of thinking like an investor as opposed to thinking like a consumer.
Mhm.
And then from there, I think it scales to whatever your niche happens to be. If your niche is investing in multifamily, then you just Googling and you can get some great books in that space. If it's self-storage, then that's different. But I think learning and then applying and then taking a long-term approach to things is very powerful. I did an example in I send out an email every week or two, and anybody on your audience is welcome to, if you just email me, robert@arcmf.com, I'll get you added to our email list. And I'll usually just send out content that helps people understand investing. Last week I sent out something saying a $200,000 investment with ARC over 20 years versus putting it in T-bills. The delta on that 200,000 would be about 320,000 total in 20 years in a 4% T-bill. So about 120 in profit. With ARC, we'd estimate it based on how we expect to grow. That 200,000 would be a total of a little bit over 1.3 million. When you look at that delta, there's a big difference over time. It doesn't get seen in year one, but 10 and 20 years out, you'll know which of your friends are investing wisely and which ones were consuming because not investing, because the money scales, right?
Mhm.
And so I think starting young and being consistent and looking for good investments that they understand, that make sure you understand the investment, make sure you're with good people who've been doing it a long time, and I think you're going to have a very good outcome.
Oh my gosh, so good. If people want to learn more about ARC, where can they connect with you?
Yeah, my email, robert@arcmf.com. Our website is arcmf.com. And tell them, feel free to reach out. I'll add them to our list if and when they're looking to make an investment. Happy to talk further and would love to definitely come back and talk to you. Any specific audience within your show. It's great what you do, Raquel, because I know you crush it in the real estate side, but also being able to offer this as a platform for people to, not only for someone like myself to share with your audience, but for your audience to really grow their investor mindset, their entrepreneurial mindset. So good.
Yeah, there's nothing like being in the real estate industry and then not investing, right? Everyone always wishes they would have started sooner. So I was so excited to bring you on. So what's next for ARC? What are you most excited about, Robert, that you guys are working on?
Awesome. Well, thank you for asking. So we're going to finish this year probably around 2,500 units in the Southeast between Georgia, Alabama, and we're also looking at Nashville and the Carolinas as new markets based on where we have expertise. My goal in the next 18 months is to buy our first property on the West Coast. So I still live in Orange County, California. I travel back and forth between our office here in Irvine, and then we have an office in Atlanta. So our goal is to actually build an ARC West, like we have ARC East, where we'd like to eventually be in both territories. We'd like to be at 3,000 to 5,000 doors in as far as real estate that we're cycling through in 3 to 5 year cycles. So that's the long-term goal. In the near term, we want to get our first property. We're looking at the states we're looking at on the West. In the West are Utah, Colorado, Denver. Sorry, Denver's in Colorado, obviously. Arizona and
I was going
Nevada.
to say Arizona has to be one of them.
Oh, totally. Yeah, no, we're hot on Phoenix, waiting for the right entry point. We think it's coming, but I've done a lot of West Coast investing in California and owned real estate in these states that I mentioned. But since starting ARC, we started in Atlanta. Sharon already had a network in Atlanta, so we tapped into that. That's why we're Atlanta based right now. But our goal is to really be Sunbelt focused over the next decade.
Oh my gosh, I love it. And as we wrap up, there's always one question that I ask every guest on the show is what does Robert do to play bigger in business or in life?
I set really big goals and then I really try and upgrade on a regular basis the people I'm surrounding myself with. So I don't like kick out the old people, but I'm looking to make sure that I've got coaches that are experts in exactly what I do. For instance, this year, one of my goals is I've got a couple of people on my radar already who are like at the status where they're billionaires. And so I don't have someone who's mentoring me that's a billionaire. I've got a lot of people that have done very well that do mentor me that are not quite billionaires. But my goal, and it's not because they're billionaires that I'm seeking them, but specifically because they've become billionaires because of what they did in value add multifamily, which is what I do. So the goal is to really have that kind of support. So as I grow, I don't want to be the smartest guy in the room or girl in the room. I want to make sure that I'm surrounded by people that have been there that will just give me that much more backing. And also, again, I'm still trying to avoid pitfalls as I try and do different things. I try and make sure that I've got people that have done it before around me.
So well said. Robert, I want to say thank you so much for being on our show. I appreciate your time. I appreciate your knowledge, the wisdom that you brought to the show today. And I'm excited to keep supporting you, ARC, and I can't wait for everyone to connect with Robert and ARC.
Awesome. Thank you so much, Raquel. Really appreciate the time.
Thank you.